to bring in right now an economist. We have with us a Bloomberg Best economist, Jim O'Sullivan. He has been rated based on data compiled by Bloomberg, one of the most accurate forecasters on the economy, coming to us from MF Global, though sitting right here with us on set, fortunately. Also, we have Scott Lanman, Bloomberg's Fed reporter here. In Washington, in New York, coincidentally, normally in Washington. Jim, let me start with you and ask you what you think about the inflation picture, because the Fed is talking about disinflation. We have a lot of people coming on this show talking about inflation that they're seeing in commodities. It's really hard to miss.
Well, right now, certainly the broad numbers that you look at, the personal consumption expenditure index, the CPI, the trend there is about 1% at an annual rate, which is below the Fed's long-term objective of close to 2%. And meanwhile, there is a lot of slack in the economy. So if anything, the trend has still been down on those core inflation numbers in particular. Now, commodity prices have been rising recently, but I think an argument can be made that commodity prices are more indicative of growth and growth expectations than inflation per se. They're really very much consistent with the bounce in risk appetite that we've seen over the past month with the stock market up and people feeling better about the outlook for growth, I would say.
So, Jim, enough slack in the economy, and you're not worried about inflation that for the Fed to take more easing steps you're comfortable with at this point?
Well, I mean, certainly the huge amount of slack in the economy is putting downward pressure on inflation, and the core inflation numbers have been slowing. Now, in the other direction, if growth is above trend, as we expect it will be over the coming year, that should provide some offset. In the end, you probably end up with continued tame inflation, but not deflation.
Scott, let me ask you about inflation targets, because it's the first time in my memory that Fed officials have actually come out with numbers with solid inflation targets. This is the first time that they've done it?
Well, this is something that, it's been talked about for a while at the Fed. It's been talked about in academic circles, but it's the first time the Fed seems like they're willing to actually put it into action to, say that they're trying to target higher price level or higher inflation expectations. They say that's a way that would get people to spend more if they're expecting higher prices in the future, spend more now, stimulate the economy. But it's still a risky strategy because the Fed has really worked hard to win its credibility on inflation through the 70s, and we're already hearing people warning that we might be going back to times like that.
Scott, how much tension within the Fed right now?
There's a fair amount of disagreement between people who think the economy is in bad shape, that we're at risk of disinflation, deflation, and people like Tom Honig, president of the Kansas City Fed, who say things are slow because we kept interest rates too low for too long, and the bubble burst, and there's nothing we can really do about it now, and the solution is not to put more easing into the economy, which could harm things even more.
Is that a concern, Jim, that the quantitative easing here could harm things even more?
I think in the end, the biggest risk would be that if they ended up boosting long-term inflation expectations more than they lower real interest rates, that you ultimately could get higher rates if the economy starts looking better and people start feeling that the Fed overdid it. But at this point, they're succeeding. Long-term interest rates have declined. It's probably been part of the reason why the stock market has rallied 10% since the end of August. So right now, what they've been saying seems to be working, but there are risks going forward still.
At what point do we hit the tipping point and they have to start unwinding, Jim, in your view? I mean, that's got to be getting pretty soon.
Oh, well, not until you're clearly getting a downtrend in the unemployment rate, and at a minimum, inflation stops going down. So we're not there yet. That may be a story for later in 2011, but clearly the focus right now is the opposite.
Are you concerned that the Fed may be shooting off all of its ammo here when we're not in a real serious crisis?
I don't think so personally. I think it's more a question of the arguments on the pro and con side for more action. But there are a lot of treasuries out there. Certainly not going to run out of treasuries for a long time in terms of buying. So I wouldn't worry about running ammo from that perspective. It comes back to, is it a good idea? And there are risks in terms of boosting long-term inflation expectations, especially with all this talk about a price level target. It is a slippy slope, what they're doing right now.
All right, Jim, Scott, thanks very much.